Good afternoon, everyone. I'll now call the Finance and Responsible Governance Committee meeting to order. This meeting's being held in person and electronically in accordance with the Municipal Act. Consent items. For the consent items, I'll read out the title associated to with the recommended motions printed on the agenda to see if members of the committee would like to deal with them on consent or hold them for discussion. Items that are not held will be deemed approved by consent with no further discussion. They will then move forward to the next general committee meeting for consideration. The first thing that we have is a presentation by staff, but I will go through our items to be held first, just because one of them is pertaining to the presentation. So the first thing is the report of the investment board dated February 21st, 2024. Can I have a member place the report on the floor to be received, or actually have that hold?
I'll hold it till after the presentation.
Great. Thank you. We have one referred item, and that is from March the 6th, 2024, General Committee meeting concerning the memorandum from A. Rear, Business Performance Specialist, dated February 21st, 2024, regarding the key performance indicators for Council's 2022 to 2026 strategic plan.
Hold, please.
And that's held by Deputy Mayor Thompson. And then the last is a report of advisory committees. Next, we have the report of the advisory committees to be received. 6.1, the report of the International Relations Committee dated February the 6th, 2024. Can I have a member put the item on the floor to be received?
I'll put the item on the floor.
Or I guess we'll go through the hold process and then we'll come back, correct? Oh, okay. Okay. Okay, and then I'll call the vote. All those in favor? And that passes. Just want to make sure I'm not passing something here. This is all one, correct? Yeah. And then the next item is the International Relations Committee dated February the 6th, 2024, contained 3 recommendations for the committee to consider. We'll now move to the recommendations not held during the consent agenda. The first one is the amendment to the International Relations Committee 2022 to 2026 terms of reference. Anybody want to hold that, or is that on consent? Okay, that's on consent. The next item is correspondence, International Sister Cities Partnership. And that passes on consent. And the next one is the Harrogate Business Improvement District International Work Exchange Grant. And that passes on consent. 6.2, report of the investment board dated February 21st, 2024. The report of the investment board dated February 21st, 2024 was received during the presentation, which I'm kind of going ahead of myself here.
Meeting adjourned. Good job.
That was the quickest meeting ever. I'm sure you'd probably be happy if you didn't have to stand there and present in front of us. So we do have one presentation this evening from the city's investment board concerning the 2023 investment management report. I've already gone through the whole thing about the thing being held. I would now call upon Craig Miller, Chief Financial Officer, and Jeff Waters, Chair of the Investment Board, to provide the presentation.
Thank you, Chairman Harvey. My role here is actually very easy tonight. I'm just going really here to listen, but I just want to take a quick minute just to remind you The Prudent Investment Board, Jeffrey Waters, you remember his presentation from last year. The board is oversight over the investment program. I just want to make sure, give credit due to two gentlemen that are here tonight. I think most of you remember Thierry Reyes. He's our portfolio manager, and Jason Bailey, investment analyst. These two gentlemen are our in-house investment team. And again, the oversight is Jeffrey and members of the Prudent Investment Board. And I will say we're very fortunate to have all these gentlemen with us here tonight. So with that, over to you, Jeffrey.
Okay. All right. And I think I have control here. Or someone has control, someone just moving on. All right, Mayor Nuttall, Deputy Mayor Thompson, Chair Harvey, and councillors. Today, we're going to go through the market performance for 2023. We're going to look at the portfolio performance in comparison, and then we're going to discuss our market outlook for 2024. So, unlike 2022, I don't know if you remember, but stock markets were down, bond markets were down. I think a few things did well, like natural gas. T-bills did okay, not great, but they did okay. Unlike 2022, 2023 was a very good year for the stock market and the bond market. And the results show themselves in the results that we have today. So just if I could have the next slide, please, or I can do it myself. Maybe I can't. There. Okay. So this is a chart of Canadian bonds, Canadian equities, and US equities. And there's quite a difference between all of them. The Canadian bonds did about 6.5%. You notice that around October, they were actually losing money. That's because the interest rates were still quite high, and the anticipation was that they could go higher. But equities performed much better. Again, they had a dip in late 2023, but they ended up the year up 11.7%. Then you look at the S&P 500 and go, holy smokes, what happened there? Because it's almost 23%. The reason, what happened is that we had 7 stocks that did really, really well. They're called the Magnificent Seven, and I'll go through what they are, but those 7 stocks drove most of the return in the S&P 500. So it's what's called a very narrow market. The other 493 stocks of the S&P 500 didn't do quite as well. But if I go to the next slide, whoops, okay, we're both doing it here. Okay. These are the Magnificent Seven, and they contributed 62% to that 22% return. A couple of the names you probably recognize, some of them you don't. The top one is NVIDIA. They manufacture those chips for artificial intelligence, and that's a really hot market right now. And that stock has gone up almost 250% in the year, which is unbelievable. But then you look at Meta, that's your Facebook and Instagram. Tesla, the car manufacturer. Amazon, well, I used Amazon today, as a matter of fact. Microsoft, Google, and lowly Apple at only 55%. But these stocks make up 25% of the S&P 500 and 62% of the return. So you can see how narrow that market was and how difficult, if you were broadly diversified, it would be to beat the market. And I'm not sure I'd want 25% sitting in those. It's very, very volatile market, and can be. Anyway, in terms of sectors for the stock market, technology was a leader, obviously, and consumer discretionary was as well. All right, let's get into the performance side of things. And you can see we've got 3 different funds here: operating, capital, and growth, and something called the consolidated portfolio. And just to go through sort of each one, the operating fund, which is shorter term, beat its benchmark. So did the capital fund by a wide margin. And the growth fund did not. And I'm going to go into that. And that's largely due to those Magnificent Seven. Now, the consolidated portfolio actually outperformed its benchmark by about 1/3%. And then you can see the other numbers there for 1, 3. About 1 and 3 years are reflective of the performance of this investment team. The rest was a program that we were doing before. Of the returns, the operating fund represented about 51% of the return. Capital fund was 30%. And growth fund was about 19% of the total return. For those of us who prefer dollar numbers, here's what it meant to the city of Barrie. So the money market earned you $14 million. Fixed income, or the bond market, bond portfolio, earned you $8.1 million. And the equity portfolio was $5.2 million. In total, $27.4 million. Now, there are two components to that. There's the realized part, which is interest, dividends, and any capital gains that were realized when stocks or bonds were sold at some point during the year. Unrealized was about $7 million, $7.25 million. And what that is the price of the stock or bond from the time it was purchased until it was valued at the end of the year has gone up. So it's not money in your pocket yet. It still can go up and down. But what you have there is potential for another $7 million of gains that you can take. So let's go into the some components here. The prudent investor portfolio returned 7.7%. It was only 8 basis points ahead of its benchmark. But the operating portfolio, and I'm going to go into what they are, outperformed by about 0.5%. Okay, now I've been talking about two different things here. We have the prudent investor portfolio, which is that pie chart in the center. And that's what we originally started out with when we started this investment program. So you can see that it's got an operating fund to it, a growth fund, and a capital fund. And I'll go into each of those. But we also have something called operating assets. And combined, they make the consolidated portfolio, which is about half money market, about 10% equity, and about 40% bonds. And you can see in total, we now have over $396 million. When we started this program, it was only supposed to be about $200 billion only. But a lot of money came into the portfolio for development funds and other inflows. And so the portfolio bloomed. But the operating assets, we don't know exactly when they're going to be drawn upon. And because we don't have a time frame there, we invest in the short term, because the last thing you want to do is go away and invest long term, and all of a sudden they draw the money down, and geez, what if we're in a loss position? We don't have as much money as we did before. So we're trying to minimize the risk there. Where we do take some of the risk is in the prudent investor portfolio, which is what we've tailored this for the city of Barrie. So I want to go into each of the components here. This is the operating fund. Purpose of the operating fund is to meet sort of cash commitments required in the next year or so. And it consists of cash, high quality short-term securities, interest-bearing accounts such as high interest savings accounts, GICs, and short-term bonds. And we outperformed by a little over 0.5%. And what drove that was what your investment team did is actively managing that cash flow as interest payments came in and redeploying them. And also going, they call tactical asset allocation, allocating into securities that they believe would be beneficial to own over other securities. So on a total basis, when you include the operating assets and the operating fund, it's $245 million that's in shorter term investments. And I think that's all I'm going to do about that, because I want to get to the next part, which is very exciting. This is where your team really showed what they were talking about. So the capital fund is to match cities' cash requirements for any capital projects underway or slated to be completed in the next 5 years. And it's fixed income instruments such as government and investment grade corporate bonds. Again, GICs, longer term. Now, this outperformed by 1.7%. And in the bond market management, that's quite an accomplishment. That's very, very difficult to do. Now, the drivers of your performance, there's something there called duration tilts. And I think I talked about this last year. Think about duration as being similar to maturity. In other words, 1, 2, 3, 4, 10 years out type of thing. And the higher the number, of course, the more interest sensitive the bond will be. So what did they do? How did they make this happen? And I'm going to turn to the next chart because it helps explain what went on. I want you to focus on the right-hand side of this exhibit. And this compares the performance in 2023 of how government bond did in the brown there, and then the blue represents corporate bonds. And notice that the corporate bonds outperformed government bonds. Your investment team was much more heavily invested in the benchmark in corporates, and that was a call that they made. And that provided some of that 1.67% return. But there's a second part to this story. And that is that interest rates and bonds are interesting things. When interest rates go up, bond prices drop, and vice versa. So I like to think of it as like a teeter-totter type of thing, okay? And this is the fulcrum or the pivot point. And when interest rates go up, my elbow is bond prices, these are interest rates, boom, prices drop. So what Theory and the team did is they moved that fulcrum so that when interest rates went up, it was a very small move in bond prices that they were holding. So that insulated you from some extent for the downside. But then about halfway through the year, and you can see that there was a big decline occurring right around August in terms of the return. I'm sorry, I did that last year too. The bond prices started to drop. So the investment team made a decision that they said, I think we should move this portfolio to a longer maturity. So they moved that fulcrum out. So now when interest rates dropped, they got a lot more leverage on the price side. That's what they did. And that was a great call. They did a really good job. So anyway, that explains pretty well what's going on there. And now I guess we'll turn to the part that underperformed. Now, we underperformed, but I don't know about you, but 15% sounds pretty good to me. And because of those magnificent 7 and the fact that the portfolio was positioned to be defensive, because last year we were anticipating there was a good possibility of an economic slowdown or a recession. We didn't get either one, but we were positioned for that. So we didn't participate in all those hot sectors that took off in 2023. So you can see our weighting in utilities, that's defensive. Consumer staples, that's defensive. They were all above the benchmark. And it's a great place to be because consumer staples, even if there's a recession, people got to buy groceries, they got to buy all kinds of things. You're not going to turn off your cable or your phone or whatever. So those are all good areas. But notice how underweight we were in consumer discretionary and information technology. Not by a lot, but these are the average weightings that we had over the course of 2023. So where are we going? Well, there are some areas. So we've got some good news actually recently, and I'll get into that in a minute. Not so much on the geopolitical side, that hasn't been all that great, or the political side. These are things that we can't control. Who knows what's going to happen? I mean, Gaza war could end, it could get worse. The Russian-Ukraine thing could get worse. Something could happen in the South China Sea. We just don't know. So you don't even consider those, but they are things that if they do start happening, you know, you might want to batten down the hatches a bit. But the second one, the risk of a recession, hard landing versus soft landing. This was a big debate last year. It's less so now, but here's the point. Right now we have what's called an inverted yield curve. And the yield curve plots all the different interest rates on bonds between 1 and 30 years. And it's unusual for shorter term instruments to have a higher interest rate than longer term ones. You know, you think about it, if you're putting your money out for 10 or 20 years, you want to earn a little bit more than the guy who's only putting it out for 2. It just makes sense. So that's the only thing that's got us a little bit concerned that potentially there could be a slowdown or a recession, mild recession. We don't think it's going to be major, but that's something to keep in mind given we have the inverted yield curve. Inflation. We got a really good number yesterday in Canada, 2.8%. That follows 2.9 in January, and it's below that 3% level. The bracket's 1 to 3%. Bank of Canada looks at. We also got some good news today from the US Federal Reserve. They announced they're going to cut interest rates 3 times sometime this year. Not yet. I don't think anything's going to happen until probably June, July. There's a Bank of Canada meeting next month. I don't think they're going to do anything just yet. I think they're going to say, show me more data before I decide I'm going to start taking the interest rates down. So what we're expecting is that things are going to be very volatile. Now, that's not bad. Volatility presents opportunities, and we have lots of cash flow being generated here. So as we see things change one way or the other to take advantage of, say, something going on in the stock market or the bond market, we already took advantage of the bond market with that shift in interest rates. And so anyway, it does provide you with opportunities to invest, and it's never a straight road. I've been in the investment business for 40 years, and some people would say, oh, 40 years worth of experience. Well, I look at it this way. I have 1 year's experience 40 times, because it's every year, it's a different market. And you just never know where you're going to end up. So anyway, Chairman Harvey, that's my report, and I'd be happy to entertain any questions from people present.
Great. Thank you for your presentation, Mr. Waters. And that's actually a very unique way to explain your experience. And I guess it actually makes sense, to be quite honest with you, because no 2 years are ever the same.
Unfortunately, it's true, sir.
Yeah. Does any members of committee have any questions for the presenter? Deputy Mayor Thompson.
Thank you, Mr. Waters. Thanks for the presentation. Just looking at your last slide and talking about interest rates and, the US Bank and what it does. Does the Canadian dollar at a rate affect us in any way, shape, or form?
Yes, through Chairman Harvey to Deputy Mayor Thompson. Yes, we have US securities in the portfolio. As the Canadian dollar drops, value of those goes up, all things being equal. And if the Canadian dollar goes up, it takes away from the return on the US side. So that's the only currency exposure we have. Everything else is in Canadian dollars, so there's no currency exposure there. But that's only a small portion of the portfolio that has what's called an exchange rate risk.
Okay, and the reason why I asked is because and correct me if I'm wrong, if the Canadian bank lowers interest without the US would deflate our dollar. And so we're kind of on a wait and see until the US bank, because of the strength of our dollar from.
Exactly.
So I just wanted to know. Thank you.
Councillor Congle.
Thank you, Chair Harvey. Thank you, Mr. Waters, and my compliments to the team and to Mr. Miller on just, I always learn something new, and I feel like, okay, maybe I'm becoming a better personal investor, because you make it very understandable, and I appreciate the way in which you're providing much complex financial information for both us, but also the public, to appreciate how, I think, phenomenal staff have taken the approach through the investment board, and kind of the strategy and the framework behind this. I think that has put us in the best possible position. So I thank you for that and for the skill set that we've been able to retain to support us. My question is, and here's where you're going to see a little bit of my ignorance, but I wanted to frame a little bit about your market outlook. A lot of our conversations, I would even provincially, nationally, I think, around how people are doing from an affordability and is about housing and mortgage rates and I don't have exact numbers, but I think the high proportion of individuals who have mortgages terming up in the next 1 to 2 years. And I don't fully appreciate, if things don't change around interest rates and people's ability to be able to enter back into mortgages at a higher rate, how would that impact things like recessions and or in general our financial considerations? And where does housing, I guess, and around, maybe I'll call it a population risk factor around individuals' ability to kind of retain that, and then also put discretionary dollars, best case scenario, if you have them, into the economy. And so I didn't know how the housing picture and concerns there might impact our next 1 to 2 years around considerations.
Okay, to Chairman Harvey, Councillor. The biggest exposure would be in the financial sector. The defaults are something that the banks allow for. They do what's called, they reserve for possible loan losses. My sister-in-law just is selling her house because she's in that situation. She cannot afford the new rates of mortgage. You know, she's at 2%. They're saying, oh, here you are at 5-6%. You know, it's quite a jump. And with housing prices where they are, I mean, my guess, and it's just a guess, and these guys are the official, would be that this is going to put a lid on housing prices for a while, because you're going to see more houses coming onto the market. They're selling. I mean, my sister-in-law's house just sold, but certainly there's going to be a lot of pressure in the coming months. And even if the Bank of Canada does lower rates, there's still a lot of people in that awkward position where they, you know, can't know what to do. My daughter-in-law, she had a wonderful TFSA that I was managing for her, and she dissolved that so she'd have the same interest payment or mortgage payment. And that's a trade-off that people are going to make. But no, it's not a good situation currently. And I don't really particularly see an easy way coming out of it, other than for the banks to start maybe stretching terms, or going to the government and saying, look, can we, you know, talk to the, you know, superintendent of financial institutions to kind of loosen up some of these rules a little bit, so we just don't have all these people having to sell their houses or default.
And if I may follow up to that, Mr. Waters, but it doesn't change that's not really a consideration in our investment strategy. Is that correct then? Or it's kind of, you know, another factor happening in the context of the financial environment, but we're not looking at that, or there's no type of impact factor based on what I'm seeing around where we've invested and that changing any direction that we're taking from a longer term strategy.
Chairman Harvey, to the councillor again, we do hold financial stocks within the portfolio. Are they overweight? Underweight. There you go. We're allowing for that. I can put it that way.
Yeah. Thank you. No further questions unless Mr. Miller had anything to add.
Yeah,
ahead.
thank you. Just to add on quickly, I think the other component we monitor is like we've got this portfolio, and it's strategically placed in different maturities. We're also a cash out business. So this money is accounted for. So if we do go into a prolonged period where developers, you know, people aren't buying new houses, then they're not going to build them. So if we see a prolonged period where we don't have development charges coming in, and we're not there yet, but you know, 1-2 years from now, if we're still not seeing the expected levels come in, the portfolio is going to shift, because that cash will need to be utilized to pay for the infrastructure that we are currently committed to. Again, at this point, we're not too concerned with that, but that's something we're monitoring from the availability of the funds that we have.
Thank you, Mr. Miller.
Great. Thank you, Mayor Nuttall.
Thank you. Thanks for the presentation, and really good to see the returns, quite frankly, in all three levels, even as you said, 15% is a really healthy return. In terms of the board as a whole, is there an opportunity, or is there a benefit to leveraging other municipalities to participate with us using the board? Is there any benefit to us in terms of having a higher dollar amount under management in terms of greater returns?
To Chairman Harvey, to Mayor Nuttall, I don't see that would make too much difference one way or another. It makes a more complex job for the investment team and how you do the accounting of who's got what. But certainly I've never found it in my 1 year, 40 times career to be particularly a problem, regardless of the size of the portfolio. It doesn't matter. I mean, you're in the hundreds of millions of dollars. I mean, you're playing in some of the bigger leagues right now. So,
okay,
especially for a municipality. So
wonderful. In terms of comparators, we have a lot of market comparators. Do we have a set of municipal comparators in terms of other municipal governments and how they did over the last little while?
Through Chairman Harvey to Mayor Nuttall. I think Craig can maybe answer that question a little better than I can. Because that's something I don't monitor. These are my guys. I follow them. That's about it.
So
Mr.
through
Miller.
you, through you, Chair Harvey, to Mayor Nuttall. So great question. They're hard to come by. There is, I think, there's the One Fund, which is a program where municipalities can join the Prudent Investment Board, become a member of it, and they hire an external investment firm that manages their funds. We can try and get their information out to see what they have. The other side of it is, from a cost, want to look at what does it cost to do their program. So it's not readily available. I know when I was treasurer in Mississauga, they kind of kept it quiet. They didn't openly advertise what the returns were for that probably reason of people comparing. But we can certainly search and see what we can dig up to compare us. And it's also understanding it's not always apples to apples in terms of the stage of where a municipality is on growth. How long do they hold their cash for? As was described by Jeffrey, we are in a defensive position on equities because we need that cash in a shorter time frame. Whereas when I was treasurer in Mississauga, they were able to hold on. They knew that they weren't going to spend that money for another 10 years, and they were, had the opportunities to be more flexible. So, but just to answer your question, it's not readily available, but we can dig up and see what we can find and share with council.
Yeah, if we could, that would be great. I think when I look at it, there are the opportunities to do comparators related to the position and tactics related to that fund. So there's going to be short term, there's going to be mid-term, there's going to be long term. How are others doing each of those places in comparison with us? And I realized we had a bit of a wonky, call it 18 months with interest rates and GIC returns, et cetera. I'm not looking for a day in time. I'm looking for a trend line. And if we don't start the trend line, then we're not going to have it 3 years from now, right? And I think that if we can grab some of that data, I'm really impressed with the medium in terms of exceeding by I think it was just give me a second. It was essentially 24% better than market. Our operating was 10% better than market. Those are great things, and especially when we're moving the daily balances around to come up with 0.5% in a year is pretty spectacular. It is huge. So thank you to the investment board. Thank you to our internal team. And if I can give one bit that's not a question here. Last week we celebrated very, very, very strongly the commitment of 6.35 from the province this year, and another 6.4-ish, 6.6 from the feds. And we show up here today and we've got 20, right? And we don't toot your horn enough on what you're doing with our funds, because they are literally newfound funds for the city of Barrie. So thank you for the work that you did. You outpaced both the provincial and federal government combined, and we hope that that continues in years forward.
Well, thank you.
Great, thank you. Is there any non-members of committee with any questions? Councillor Corser.
I love when, through you, sorry, I love when Mr. Waters comes, because I always scribble notes madly and I find it very exciting, and I wish I had more money to invest because that would be fun. I really like the way that the volatility of the market can cause inertia, or it can cause like jumping around trying to catch things, or the insecurity. But I guess it's more of a personal or a smaller trading, as opposed to people who are obviously very experienced. I just wondering, first question I was going to ask, it was probably already answered, was the exposure that we have to international markets that may be very volatile at these times. I see that there's a lot of quick movement in the investment world where necessary. So I imagine that we're not locked into anything long-term that could be damaging.
To Chairman Harvey, to Councillor Corser. No, all of our securities, with the exception of GICs, are totally liquid. We can sell them at any given time. If our strategy was to change, if we wanted to change asset mix, we could do that as well. I mean, we're not went to the benchmark, we can vary on either side of it. We have brackets in our investment guidelines that say, here's a scope that you can operate within, anywhere within here, but the center point is the benchmark. And whether you choose to underweight or overweight is your decision, and that's what the management team does. I hope that answers your question.
Yes, and thank you. And just a follow up that maybe might be through you, Chair Harvey, to, I guess, Mr. Miller, how often, or it could be to Mr. Waters, I'm not sure, but how often do we withdraw from these accounts?
I'm going to defer that one to Thierry.
Okay, thank you.
Calling back up now.
For you, Chair RD, to Councillor Porson. So just to clarify, when you say account, you mean the funds or
The portfolio.
okay, all right. So the operating fund is pretty much liquid. So we move funds into it pretty much as we see on a daily basis, depending on where we can get. So that's more frequent. But bonds and equities are usually rebalance when we got, for example, when there's tax collection. So then we know we have money coming in, then that's an opportunity to rebalance the portfolio. So that's kind of less frequent, but the rest, the operating fund, this is more proactive. So, and to answer also the other question that you had prior, so there's no international exposures, really the US. So other than that, we don't have in order international exposure.
So whatever exposure they have, we're kind of riding a little bit of that because we're investing with them to different international companies then? Is that through different stocks that the companies that are doing, correct?
That's correct. But so the US is basically mainly the 500 largest US companies, right? So the S&P 500.
I think, did you want to add?
Mr. Miller.
Sorry, if I could just jump in. Thierry's being a bit modest on the operating component. So as I said, we've got operating expenses, salaries, AP goes out all the time. Thierry and Jason are very active. When money comes in, it's out. They have it invested. They've got a reputation of being pretty hard with some of the local banks and getting the best rates and pushing hard to lower their margins. So it's not just this casual, as he's saying, they're aggressive, and that's why they're able to pick up some extra points on the short term. And it really just justifies this type of resources in the organization, because you're not going to necessarily get that if it was external, but they fight for every penny. Sometimes I sweat. We don't want to be in an overdraft situation because you invested all the money. So we do manage the internal cash flow, but they're pretty active every day.
That's amazing. That's really great to hear. Thank you very much.
Any other members of non-committee? Well, thank you very much to you and your team for everything that you've been doing again this year. Obviously, when you're exceeding benchmarks, and especially with the way the world's been the last few years with the volatility, it's great to see that we're still running in an extremely positive direction when it comes to that, because I know there's some people I know that are fairly heavy into the investments, and they haven't seen the same thing in their portfolio in the last 36 months. So again, thank you to you and your team.
Thank you.
So we'll then move to the two items that were held. The first one was the first one is to receive the 2023 investment management annual report. Can I get someone to put it on the floor, please?
I'll put on the floor, Chair Harvey.
Great. Thank you, Councillor Kungle and Mayor Nuttall.
Thank you. I didn't answer this question because it wasn't exactly directly related to the presentation itself, but rather the corporation's outlook with relation to our investments. So inside of the 2023 budget, was there an amount that was expected in return from our portfolio?
So through you, Chairman Harvey, great question, Mayor Nuttall. So On the operating side, yes. So if you remember, we have the promissory note from Electra that we're actually, if you remember, we're getting that back in May. So we have, don't have the amount in front of me, but we've an investment return in our operating budget related to that piece of it. And then there is a small residual to cover our investment team pays for themselves. So there is some revenues that comes in and pays for them. Most of our portfolio is from our reserves. So there's the obligatory reserves from DCs. So it's not budgeted directly. It's forecasted within our continuity reserves, but it's not, we account for it, but it doesn't impact your overall operating year, like your tax number. But we're going to take a look if we do better with the 20 million that's available to us specifically for operating on that return. We probably will be able to increase that amount next year and as time goes on, as long as we still have that in place.
So when it comes to our reserve balances, then let's focus on that versus the operating. You start the year with X amount of dollars, January 1. Do you forecast where you expect it to be at December 31 based on interest return or any other dividend return or whatever?
Yes, and it's an evolution because really it's based on cash flow. So the capital plan, how much are we going to spend this year? So we kind of internally have discussions, and from those discussions, the estimates, then we calculate, okay, what would the return be? I think we're getting better and better. And those are pretty substantial returns that are going into our reserves, more than we had anticipated. But it is an evolution, is you got to get better at forecasting your cash flow needs. But to answer your question, yes.
And when, recognize the impact cash flow has on it. So is there a ratio that we can come up with that shows balances versus return, so that we can understand how we're doing, in the sense that, 27.41 is a lot of money. I don't know how much of that was because we increased our DC reserve so substantially in the last 16 months. If that's directly tied or not.
Well, just so today, or roughly as of the end of December, it's roughly 400 million. 75 of that's DC. And just remember, it's all committed. There's water, wastewater. I think it's probably a similar amount. Again, all committed. There's the tax capital reserve. I mean, it's committed, but I think it was close to 90 million of it. So DCs are a small part of the balance at the year end. Now, how the earnings get allocated, it's really a weighted average during the year, each month. Like, for example, obligatory reserves, federal gas tax, DCs, it's pretty prescribed how you have to allocate it. But we basically do a weighted average for the year of what the balance was, the ins and the outs, and then we apply it to the overall return.
So netted out overall, let's say a quarter of it's DC related and 3/4 is not, or it's probably more like 80% is not and 20% is DC related. Did we envision having this much return in our 2023 budget when it was approved I think we approved it in February last year?
I don't think that much, but I will say when the DC background study was completed last year, it did calculate revenues that you generate to help that go into your reserves that help lower the rate. So at that time it did. That's when it would affect the rate. But I think we were lower than what we were expecting here. It won't really affect the outcome today. I mean, maybe a few more years with higher returns on that in terms of the timing of projects, but it could.
And going forward for 2024, did we set an expected return for 2024 based on, we did fairly well in 2023 beating market?
I think getting investment folks to commit to a number is difficult to do. I think that's why they kind of have the benchmark. So I don't. I think we probably have a conservative number in the budget, but you know, as you know, we were down on equities, and could be a little pressure on the bonds next year. So I think it's probably from the, you know, we're generally conservative on the finance side. Prudent to be conservative, just so we don't have any unexpected surprises.
Okay, so my final two questions. At the beginning of 2023, I think we had $100 million deficit inside of our DC reserve. Is that roughly correct?
We probably had it. I'd have to double check it. It's a overcommitted balance. So there's the cash balance. So the cash balance wasn't. So right now at the end of December, we have 75 million. But we have committed so many projects, we were overcommitted. And I think this is critical. And this is my point. If DC stops coming in, that's the risk to the city and the return. But we're not worried about that today. But so we had positive cash, but negative commitments. We were overcommitted. And I'd have to double check from memory, but I'm pretty sure we were close. And if it wasn't this year, it was coming.
And is it as we brought in those dollars, we're then able to invest? A substantial amount of them came in before a deadline, as I recall, in terms of DC bylaw, and then prior to that, it was a December 31st related item as well. So when we're looking forward, right, we are expecting 2 or 3% returns. I'm guessing 4% returns. We're estimating inside of our budgeting process.
I think we'll probably come back, and I don't want to commit to that, but in the crystal ball, I don't think that would be unreasonable. But unless there's some foresight that we're going to keep up 15%, that might be stretching it. But yeah, that's probably reasonable. The other part too is our infrastructure engineers are going to spending a lot of money. So when that money flows out, the DC reserve doesn't get as much money to it. So I just remind you, it's a weighted average. So if we have negative DCs, there's no money to invest. It's going to federal gas tax capital reserve, water, wastewater. And I foresee, we expect that's the normal process as you're building a community. You're going to see those DCs hovering around zero, especially last year, 2023, I think we were about 50 million we collected. The previous year it was 100 million, and the year before that was 100 million. And it's a slower time right now. So the cash flow on DC reserves is going to go out. So I don't think there's the return on DCs probably will be the amount of money it earns will be lower because the portfolio for DCs would be lower.
100%. I think I'm less concerned about the DCs and more concerned about the dollars that are city dollars, in the sense that these are newfound dollars for us going forward, especially if our estimations are 1% and 2%, which typically they were a decade ago, for instance. I think would have been lucky at 1 or 2% a decade, to be honest with you. And today we're looking at, I'm guessing over the year, because of the increase in funds on under management, there'd be a 7%, 6.5% return or something like that overall that we were experiencing throughout the year, which ends up, if you were to take it today, I mean, 27 into 400 million, you're still in a really good number as well, but we're in an escalating position, right? So that's what I'm trying to get at.
Yeah,
These
it's
are
positive. We have more
solid
money
returns.
now to
Yes.
finance our capital projects. And yes, this particular year, we have more money than we thought we were going to have because of the returns money that the taxpayers' money went to work and earned a good return, and now we can do more with it.
Absolutely. Well, in politics, I'm told that you're only as good as your last vote, and I will pass that on to the board as you manage it and come back next year.
No pressure on that remark, eh? Is there any other members of committee with any comments? Any non-members of committee? No? Okay, with that being said, I'll call the vote. All those in favor? And that passes. The next item that was held was a referred item. If I could get Deputy Mayor to put it on the floor, it's a memorandum from the circulation list dated February 21st, 2024, key performance indicators for council's 2022 to 2026 strategic plan.
I'll put the motion on the floor and move a deferral motion to the next Finance and Good Governance Committee meeting.
Great, thank you. I doubt there's going to be any conversation around it. It's just a deferral, so I think we could talk about it, not that we need to. So I'll call the vote. All those in favor? And that passes. That's why we have Madam Clerk keeping me in line here. So apparently I breezed past 6.2 in regards to the minutes of the investment board dated February 21st, 2024. Can I have a member of committee put it on the floor to be received? Thank you, Deputy Mayor Thompson. Any questions for members of committee, non-members of committee? All those in favor? And that passes. And with that being said, this concludes the Finance and Responsible Governance Committee meeting. This meeting is going to be adjourned and General Committee will start in 4 minutes or so at 7 o'clock.